All deal. Good afternoon, everyone. Welcome back to the Schwab YouTube coaching channel for our final class of the day, Building a Stock Portfolio. I am your host, Kevin Horner. I am a senior manager and trading coach with Charles Schwab, and I am pleased you're all joining me today. We're going to spend a little time with a brief review of the market. At the finish today, we have had a nice little bounce, a needed bounce in some areas, and we're also going to explore our example portfolio to make some adjustments to our exit strategies there. One of the main processes we undertake in this particular class is working to maintain our underlying investment positions, our example portfolio, for as long as possible, but also elevating and raising our stop orders along the way so that we can take advantage, or in an effort to take advantage of the trend continuing and only looking to move on when the trend truly breaks down. So that's going to be a big part of what we do today. And then, of course, we're going to explore for new opportunities, example trades that we're going to place in the example portfolio as well. So that's about what you can expect today over the next 40 plus minutes. We are joined today by my friend and fellow trading coach, Connie Hill. Fantastic coach, CMT, wonderful person to learn from, and a perfect individual to have in the chat for us today as well. Connie will address comments and questions that I'm unable to get to, but you know I'd like to keep an eye on things, so I'm going to do just that as well. So please feel free posting in there for our the entirety of our show. If you're not already doing so, you can follow Connie and me on X, Connie Hill CS and Kevin Horner CS. X, not exactly a everybody's favorite place, but if you're interested for tracking coaches and learning finance, I'll tell you what, X is a wonderful location for us, and it's certainly the best place to find us coaches when we are not hosting classes for you here on the channel. So do take a minute and follow us there. And of course, if today's conversation is helpful for you in some way, you can always press that thumbs up button down below for me. We do get these reviewed and shortly after into the archive for you for subsequent viewing, so you can get caught up a little bit if you need to, and you can also take advantage of maybe your commute to watch these if you're on a train somewhere, perhaps. If you're driving, no watching, all right? Audio only. Now, with that, let's jump to our disclosures and we'll get down to business. Please remember that everything we cover today is for your information and your education only. We do not make recommendations. We do not make endorsements for any specific approach to trading the market. What we will do in this class, however, is discuss technical analysis, and I like to do that as a means of evaluating the overall market and obviously individual positions within our portfolio, our example trades, and we also incorporate technical analysis when discerning our new example trade ideas as well. But technical analysis is not the entirety of your decision making, at least it should not be. So we do not encourage you to make decisions exclusively by what you see in technicals. Make sure that that could be one of your decision making pieces, but not the entirety of it. Of course, in this class, we don't discuss options too frequently, but you do need to know that options carry a higher level of risk and are not appropriate for all investors. You do need to be, in order to trade options at Schwab, you need to be approved previous to placing those trades, of course. So you do need to go through your necessary steps. Make sure you do that and make sure you're familiar with the risks and disclosure statements for options that are offered by the CBOE. All right, so as stated, we're going to go through this type of an agenda, reviewing the market activity at the close, looking at some of the trends, and exploring new opportunities for our example portfolio, but also looking at the example portfolio so that we can adjust and make alterations to our exit strategies. Please feel comfortable dropping your questions into the chat. Now, we're going to start with a look at the S&P 500 here, which essentially we've gone nowhere for the last 2 months, everybody. We have established a pretty well-defined trend, and that is currently sideways. And yes, sideways is a trend. Remember, stocks go up, they go down, and they go sideways. So we are currently in the midst of that sideways development, as you can see here, everybody. This is leading to some maybe a little consternation amongst traders because you're waiting to see, can we get ourselves back in trend? Right now, sideways is all we can say. In fact, we could note that we've been below the moving averages, the orange and purple, those being the 20 and 50-day moving averages. And we've been below it now for, let's see, about 1, 2, 3, 4, 5, 6, 7, 8 sessions in a row. Below them, essentially below them all at the close. We did have one good close there 2 days ago on Friday, but we closed at the 20-day and then lower since. So basically maintaining the trend. Now, one other interesting aspect is that when you are thinking about stocks going sideways, one of the ways is just, oh, we've got this level at 7,000 and a level beneath us at 67.75 or so. But some traders will also look for the mid-range of that range. So we've got a 225-point range. If we went up about 115 approximately from the bottom, that would put us at around, oh, how about that? How about 68.85 to 68.90? That's basically the halfway point of the range we've traded in. So, this is just another way to kind of give consideration to what's going on. But ultimately, because we are sideways and haven't started trending yet further, we don't really have a clear view of the potential, the increase of likelihood for going up or going down from here yet, which will likely only happen with a close over 7,000 above us or potentially a close below about 67.75 beneath us. Beneath 67.75, odds increase for a deeper pullback, potentially to the 200-day moving average down below, right around 65.50 or so. And of course, a close over 7,000 would be a nice development for the S&P. Let's see, as Jay calls out, maybe NVIDIA can be the catalyst for us tomorrow afternoon to push the S&P higher. We'll wait and see. Now, in the NASDAQ 100, we got a nice little bounce back here today, up more than 1%. The group has been struggling, of course. We know technology has been under pressure, but specifically software has been under pressure. And this sure has a similar look in the sense that we are still below both of those major moving averages, the 20 and the 50, as you can see, have been below it since about February 3rd. So basically, the month of February has been a real challenge for the NASDAQ 100. The interesting aspect of this is, of course, that the semiconductors continue to trade near highs. There you go. See, you have a group that's almost set to break out there, right? Really close. Tried it today, couldn't do it. Maybe that's simply waiting, right? Waiting to see, what does NVIDIA give us? Is it a lot of discussion about the CapEx spend and the need for more chips, and NVIDIA is behind the curve on chip creation? And that's a good sign as it relates to the rest of the market, of course. And if NVIDIA is still in this need to continue to develop, that's a pretty decent indication of the thirst for their chips. So, this is an interesting development, but again, it's not, we have to think about tech, or we have to think about all of these spaces based on their leadership groups, right? Industries have sub-industries within them. Sectors have industry groups and sub-industry groups within them. And the one that's been the biggest struggle, of course, of late within tech has been software. Did get a little bit of a bounce, but it did get a little bit of a bounce after a breakdown today and yesterday. So, could this be one of those flush out moves where we break lower, we have an RSI that's giving you a bullish divergence here, admittedly limited in scope? Sure, this could work that way, everyone, but it's fairly clear that software is in a bit of a struggle, and we really can't claim that we could even get much of a relief bounce until we get back above the 20-day moving average here. So that's something that a lot of traders are going to keep an eye on. But the positive takeaway, of course, is that with technology being under so much pressure and with the S&P 500 residing still in this upper level range, well, if we can get any participation from that biggest group technology in the S&P 500, well, then maybe we can, in fact, move to new highs. But that's why tomorrow is such an important afternoon with NVIDIA's report. And here's what I'm referencing. One more time, I'm going to do this for those of you who maybe haven't seen it. We'll just go to the heat map real quickly for the S&P 500. When we talk about our leadership this year, it's been energy. It's been staples. It's been utilities and materials and real estate. Look at how small those 5 sectors are in the S&P, and look at how big that info tech space is in the S&P. We are not getting the technology leadership, and so suddenly, if that changed, with the catalyst being NVIDIA, then yes, we would potentially have an opportunity to break to those new highs. Okay, so that's ultimately what we're looking for. Some participation from tech that suggests that this has been merely a pause as opposed to a bit more of a negative window in time. Good question, Helen. I think that's a fantastic inquiry. Can we move it without the financials participating? Size-wise, I think many a trader would tell you yes, but the financials are a group that has recently shown a bit more of a breakdown, and today's bounce certainly not inspiring, right? We didn't have it work its way halfway up yesterday's breakdown candle. It's potentially a signal here that the financials are still in a process of working things out. Now, there is a ledge of horizontal support beneath us down there. Do we have to get there? No. But I think it's more likely, Helen, we could make the move without financials participating immediately if it's technology leading. But that's, again, tied to the percentage of allocation in the S&P that's tech versus financials. And again, financials have a nice chunk as it relates to the large caps here, the S&P 500, but not the same as it is with maybe, say, the Russell, which has had an interesting spot here, because ultimately all we've done with the Russell is continue testing that 50-day moving average. So you've had some positive indications from it. We are in consolidation off that most recent peak. Some traders waiting to see, can we break the downtrend line so that they can go long again? And remember, some of you like the idea of participating on a break of the downtrend line as being your first re-entrance to a continuation trend. Others wait for additional levels of confirmation, but whatever that is for you, you want to have that kind of well-defined. It's pretty clear here that if I eliminated the 20 and the 200 and you just looked at the 50-day for the last 12 months or so, everyone, well, there's 2 years, right? But here's where we recaptured it back in late or early May, I should say, last year. The instances above it have been perfect in terms of the trend, and then the one window in time beneath it was when tariffs were discussed and we didn't have a whole lot of clarity on what was going on last April, and then that all shifted. So basically, I say last April, excuse me, when we broke down here in December, pardon me. This would be the breakdown in April, but again, the recapture of the 50-day was paramount to small caps. Okay, so with that, that's your kind of brief review here. We took a little longer than I wanted, maybe a moment or two, but let's briefly jump to our example portfolio here. We are going to make some adjustments. I'm going to work quickly here, everybody, and I apologize if it's too speedy in my effort, but I'm going to try and do essentially the same step every one of these individual example trades. And that is basically taking our mathematical calculation of the average true range for the stock in question and going beneath the supporting moving average by the amount of the average true range and using that calculation to define our new stop order level. Okay, so let us start us off with one oak, OKE here. I'm going to hit my 5 so it populates my chart. You can see we've got a little bit of profit, but about half of it got eroded with today's move lower. We're going to go to the chart, OKE. We've got just the 50-day up. I'm going to go ahead and replace my 20 and 200s. And there you go. We had a test of the 20-day today. Why am I calling it a test? Well, because we closed above the 20-day. We have the tail beneath it, but we closed above it. So many traders are going to look at that and say, all right, we've had a validation of the 20-day. Now we need to ensure that we are elevating our exit strategies. I'm going to apply my show trades box here so that we see where my existing, orders, pardon me, not trades, show orders. There we go. So we see where my exit strategy is. Here, we're in to sell at a stop of 78.41, but we have the opportunity, we don't have to do this, but the opportunity is to elevate this stop from where it is up to about $80.07, which would be picking up about $1.50 approximately from our existing stop level. The reason we would do this, of course, we would like to take the effort to reduce our downside risk. So I'm going to simply right click, cancel replace, and I'm going to put this in at my mathematical $80.07. And I'll just remind you how we got there one more time after I submit. So again, we're just elevating to 80.07, good till canceled stop. And the risk factor here, of course, is once more that when we trigger, it becomes a market order to sell. That means we have no validation in price, even though we are raising our stop so that we get stopped out on a move under 80 or around 80, I should say. There's no guarantee that that's going to happen. That's because we have gap risk to be concerned about. And so all I've done is take the 20-day moving average at the close today, 82.50, and I reduced it by the amount of the average true range, $2.41, and that's where I came up with my approximate 80.07. I'm going to probably work with my numbers that I created from my pre-work today as opposed to anything else. So if I'm off by a penny or two here, please forgive me. I do notice we have a survey. Great. Survey opportunity in the chat. As always, your input is valuable to me. Last week, we talked a bit about why not these other groups. Well, that's precisely why today we are going to search the market for opportunities in one of those groups, utilities today. But we didn't do that last week. So many of you stated, hey, let's make sure we're expanding. We're getting all that exposure to the other areas that are leading. And that's why we're going to do that. So your feedback can help with that. You can click that link and let me know your thoughts. Give a score if you'd prefer. But all of that commentary comes to me directly, and I am very pleased to read it. So I always appreciate hearing from y'all. Okay, so there's our adjustment on OKE. Let's check out Schlumberger. Schlumberger are now SLB. We have this one moving as well. As you can see, we've got our stop in at 47.24. The position is dabbling with a bit of a breakout, isn't it? It's pretty close. Let me change my line. There we go. We've got all of these tails, but today is the highest close we have seen. This looks like a bit of an ascending triangle, whether you drew it from the last support test or maybe you draw it from back here. You could even draw it from the gap level back here if you'd prefer. But ultimately, it is a bullish uptrend rising with the 20-day moving average in orange. And so the 20-day moving average becomes our supporting moving average. It's at $50.30 at the close today. And our current stop is at 47.24, and the ATR is $1.52 or so. So what we would do here is just increase our stop. So the math on this is $50.30, our 20-day moving average. And in fact, I'm going to go ahead and do this on the calculator. Maybe this is another step that can be helpful to some of us. So let's find it. There it is. All right, so we've got $50.30, and then we have our average true range. Today, $1.52 if I round that up. So 1.52 gives us 48.78. Now our existing is at 47.24. That means by elevating the stop to that 48.78, we are working to pick up $1.54 in this trade. So we are trying to increase, or rather to decrease our risk tolerance by that $1.54. That's a good indication. And if every week we come together, we are raising our stops, that's an excellent sign for the trends that we are trading in our example portfolio. So Here, we're going to go up to 48.78. In this case, I'm just going to push this up. Remember, you can click and drag your orders, and that says 48.78. That's what I'm looking for, right on the nose. And keeping it good till canceled, hit send, and we'll be good when the market opens for us tomorrow. Hopefully, that's just a run that just rolls, continues. Yes. Great question, A-Trades. Let's do that. In the monitor tab next to position, how do you get the link to chart number? So that is an easy fix. It's one of your columns. Just go into the gear under each one of these, and it does have to be each one if you are asking this to break this down as I have by sector. So you make sure when you have it asking it to break out your trade portfolio by the sector, each one of your sections is a different set of columns. So click the gear, and all you're looking for here is send to. And so just pick the right one. And some of us, like I, for example, on my monitor when I'm trading for myself, I put in 1 or a 5 for my standard chart, but then I have other intra-period charts, and I might make that a 1 or a 2 or something else on a different monitor, and I can populate that real quickly as well. It is a very great function to have in these areas. Easy and quick to make your process a little bit faster. Okay, thanks for that question. Let's keep it rolling. We've updated OKE and SLB. We have to do something similar. Let's keep, my next one is Cabot. We do need to take a look at Cabot. The difference on Cabot's actually a couple of dollars. This one has moved nicely for us. Now, the reason is last week we didn't make the adjustment on this, so we're in at 70.17, and our 20-day, this doesn't look quite as good as it did when I was doing my pre-work today. Earlier, of course, that tail, that candle looked bright green, was filled in all the way. It looked like it was the highest close we had seen, maybe since back here on the 12th, which would have been great. We can still raise our stop as a means of taking advantage of the rising trend line, right? That orange 20-day keeps rising. So 20-day today is at 74.57. And we need to reduce 74.57 by the amount of the ATR to 242. All right, so 74.57 minus 252. And that tells us that we can put our stop in at 72.05. And currently, our stop is at 70.17. So we're elevating this by almost $2 full, everyone. So that's a nice development. We'll go ahead and just shove that one up to that approximate level, 72.19. 72.05 is what we came to here. We'll go with 72.07. So we're pretty close. Now, I try not to get too cute by picking these to the number, but believe it or not, when you go to the penny like this, you're going to see instances where we get stopped out because we were too tight, and it can be the difference of 1 or 2 pennies. It can be really, really small. All right, so we've elevated Cabot. Now, some of you, one thing I will call out is that some of you might notice now that we are above the 50-day moving average. Some of you might say, I'd prefer to be below the 50-day because it continues to offer me the likelihood of maintaining the security in the trend, because you could still fall to the 50-day and still be in an uptrend. So some of you might want to see that lower. Hopefully, this just means that the 20-day that's been working for this whole rally continues to work. A lot of traders would look at that fact and say, hey, we've been above it since November 25th. That is basically 3 full months. And if it breaks, you don't want to be in it still. All right. Some of you would say something different, but that's just one consideration. So we're going to stick with working off the 20 here on this one. All right. Next, we've got Core Mining, CDE, formerly Coeur d'Alene. CDE has managed to move really nice this week. They had earnings last week. And last week in our class, I stated we're not going to make the adjustment. We're going to keep our stop order below the 50 with the belief that the earnings could help us out. Well, it certainly did. So CDE has risen, and we've got our current stop in at 17.94. Now our 20-day is at 22.69. And our ATR on that is, let me add that back in, it's $1.70. So we're going to go $1.70 beneath it. And we've got a new stop just shy of 21. So we're going to push this up to $20. Did I do that right? Let's see. Oh, I know why. Because we've been working with the 50, not the 20. So, excuse me, my math is a little bit off because when I did this previous, I was basing it on the 50-day, not the 20-day, excuse me. So the question, I guess, is for many of you traders, do I want to base it against the 20? Do we want to base it against the 50? We'll continue to work with the 50 because that's what we started with. If we move to new highs and we keep trending with the 20, we can make that adjustment along the way. That's not a problem. But we're working with the 50. So it's 21.01. My apologies, everybody. So 21.01 less our $1.70. And that's what gives us a new level at 1931, which is going to be relatively elevated here. Let's see here. From 17, where are we? We're at 1794. Yeah, we're going to kick that up a bit. To the 1930 from, yeah, okay. So we'll go here. $19.31. Good till canceled. Let's make sure. All right. And so we've elevated that now, and we're just beneath the 50-day. Okay. All right. Next up. And by the way, I hope what you're taking away from all of this is, hey, these are all the same positions that we had last week. We haven't been stopped out. That's a good sign, right? It tells us that we have managed relatively effectively on these example positions. We're going to check on Caterpillar. This one's been moving great. We're up a couple thousand on this. This is our first position in the account. We have a stop below the 20-day by the amount of the ATR, but the ATR has been climbing, shrinking as we've consolidated, and the 20-day has been climbing. So the 20-day here at 722.43. Less the ATR of 23.63. And that gives us a new stop level at 698.80. And we are currently in at 674.23. So we're picking up about $24 on this move, trying to capture that with the elevated stop price. So we're going to push CAT. Example trade exit up to 698.80. I'm going to do that right here. Whoops. 698.74. There we go. That's a good year too. All right, and I hope you're also realizing, everyone, I'm using these pennies, but on round, not round figures, not zeros and nickels, but rather those in between. All right, so now we've got an elevated effort there. Okay, let me go back into the monitor. We've got Tyson, and then we've got Amgen, which we just put on last week. So we'll see if there's a benefit there. Tyson is going to likely be status quo. We are beneath the 20-day now. Looks like 1, 2, 3, 4, 6 consecutive days. Now, we are at risk. Everybody will admit it, right? We have a stop order that's above the 50-day. When we're below the 20-day, now we have a greater likelihood of testing the 50-day. So this is a tricky part because many of you will say, well, Kevin, I'd rather move that stop order lower under the 50-day moving average. And that could be the right call. However, I am loath to reduce my stock stop orders. And the reason for that is that I incorporated the stop based on the trend when we built it. And I don't want ever to lower my stop order because that means I am taking on more risk than that with which I've started the trade. I don't want to do that. So what we're going to do is keep this order in. We're going to keep it as is. We're going to hope that the trend continues, that we find some semblance of horizontal support down here with this recent move, and that we hold that horizontal support and get back above the 20 and ultimately make a new closing high over 66, which would be great because then we would likely have a chance to once more raise our stop. But I had to bring this one up because I know so many of you will want to decrease the stop order, put yourself lower, but fall back on the work you did. Remember, you did the math on the trade. You determined how many shares to own based on your stop strategy. You don't want to reduce the stop order because it means greater risk to the trade than you began with, and we don't want to increase risk. Okay. Besides, if we want to increase risk, the way to do it is to add to your position when we are moving and you've got confidence that the trend is continuing. It's a little unclear at this point. We are holding the 50. We are below the 20 though. So we're going to wait and see. Next up is Amgen. And we did put ourselves into this one just last week. We were hoping for the break continuing because we got last week we spoke about it right here, the day one outside of the downtrend line. And I heard from some of you who like this concept, buying on day one after the break of the downtrend line. Others want to see that day two outside of the downtrend line for some confirmation or validation, but it helped us by stepping in originally here. We actually got in, I guess, at the open here the following day. So, but we based it on the fact that we traded outside of basically the flag, right, on last Tuesday, and that put us in the trade. Now, our 20 days at 364.40, and that is up, and we're currently at 344.94. So we need to bump this up by the amount of the ATR, $8.66. So we're going to go 364.40 minus the 866 to give us our new stop level. And that's 355.74. And that mostly jives with my pre-work as well. Pretty close. All right, so we're going to push that up to 355.74. 71 will be just fine. There we go. Good till cancel, just validating everything there. And then you'll see, everybody, we are still below the 20-day moving average there by a proper amount, right? But the nice thing is, again, by moving this higher, we have essentially tried to capture an additional $11 of a profit here by elevating the stop the way that we have. All right, everyone. So there you have it. That is our adjustment to the example portfolio. Oh, those should automatically be there, Rita. Let's go into the moving averages for you real quickly. Everything in here should be via the gear. So under the gear, we just make sure that under SMA, you've got it show plot, show bubble, show title. And that should apply them. Although admittedly, they don't always populate exactly the way I'd like them to for some reason, but the orange 364.40, the purple 344, and my blue 308.04. That's the 200-day. And then, of course, the green is your last trade in this case. Hope that helps you out there, Rita. And this one's interesting because Amgen is close to a potential breakout. So you've had a bull flag, resolve bullishly into the prior highs, and now we're hoping we can create another new flagpole like we just did here. If that could happen similarly, it possibly could be the height of the pole. So if it could break out, could it add as much as 40 points? It's certainly a possibility. Okay, so let's get into a quick look at the utilities. So let's first of all talk why utilities. Well, you know why. We've been talking about it. Utilities change on a year-to-date basis. We've got energy in the lead. We've got materials, staples, industrials. There's utilities. We have yet to add utilities. They are up 10% year-to-date. Now, one thing to be aware of as it relates to utilities, everyone, this is, of course, a sensitive interest rate environment. What we're going to notice here is that I have applied in my watch list, which, of course, I did by, first of all, scanning and saving my scan as what I call it, I'll show you here, everybody, uptrending all time frames utilities. Okay, so by saving it as a scan, that's what makes it available to me as a watch list. So I loaded it in my watch list tool. And so I've got that scanned list. And now that list, and just again, for the record, all I'm looking for here are in our S&P 500 utility stocks that have enough volume to get me in and out. So liquidity at $500,000 on average per day. And then their closing or last trade is above all three major moving averages at the same time. So above the 20, above the 50, above the 200, thus increasing the likelihood that we're looking at uptrending stocks. Now, the key that I've added in here is the dividend yield. And I do that because it's important that we define what our process is. Do we care that it's paying a dividend, or are we simply trading it for the trade? In our case, we like the dividend. We wouldn't mind earning the dividend and continuing to maintain investment for this one as long as we possibly can. So what I wanted to do is bring to the table's attention, essentially, we've got performance based on a 1-year return, or 1-day return, excuse me, just today's change. And then I've got the dividend yield over here on the right. Now, some of our traders feel like they like to buy on down days. So we could look at something like a Con Ed, for example, down relative to the rest of the group, but pausing after having tested resistance, it could be said, right? So we got up into resistance, we've pulled back to the supporting 20-day moving average. This could be intriguing because we might have a very limited amount of risk if we chose to move on a close under the 20-day. And it's paying at a pretty decent yield, 3.4%. Dominion, D. We've had a similar move. Here was a consolidation, and since consolidating, it broke out. And what did it do? Did one of the more common things we see, right? Breakout, pull back. 20-day moving average, maybe this one is an opportunity here. Let's see. I hear you. Zinc, let's see your EXC. So, all right, very interesting. Bull flagging at resistance. Here is a decent indication of long-range support, right? We've had a lot of support in this approximate level. And most recently ran to the same thing and then broke the bull flag just yesterday, today giving continuation. Now, we could look at this as a range situation, right? Range to the bottom of the range, finally back to the top of the range. So what is the range? Well, it's about 48 down to 42. So about a $6 range. That means perhaps we've got the opportunity, if it closes above, for as much as maybe a $6 move to the upside, right? We can take the height of the range. If it breaks, we could look at it like that. That's one other consideration. But again, the unclear thing about this is, would it start trending afterwards? Because what we want to capture is something like this move here, right? Where we went and tracked that 40-week moving average in white here. That's what this moving average is. Tracked that weekly so clean. We want to participate in this kind of a move. The breakout would be great, but we want to carry the trend. And so I thought maybe we would look at one of those that were kind of offering a bit more of that trend view. And so there's a few in here. Ultimately, for our purposes, the most important thing is that we expose some money to this utility space. So we can go with this one. Why not? Let's set this up, though. Where is an exit strategy for you traders if you think that this is going to break out? And again, this is a little tricky in a situation like ours when we can't put ourselves in the trade at the after hours session. So we can only buy tomorrow morning in anticipation of a breakout. And that puts us at a little bit of risk. So we want to be a little bit cautious, right? And I think a lot of traders would look at the low we created in the flag, which was basically the low here, right around 47 or so. All right. Now, I'm going to also give thought to maybe working with a faster moving average. So what about not the 20-day, because the 20-day is way down there. It's $1.30 away. What about the 10-day? Can this give us some confluence? Aha, a little bit. So maybe the idea now is, in building out a trade in Exelon here, everyone, maybe the idea is we use the 10-day minus the ATR for our initial exit strategy, which would be $1.04 below the 10-day. And the 10-day at 47.23, that would leave us at about what, 46.19 or so? That would be perfectly appropriate for a short-term exit, and to say, hey, if we got below the 10-day before breaking out, well, then there's clearly not a breakout happening in our window of time. So we wouldn't want to participate. We'd be happy to get stopped out and move on. So that's what we'll do. We'll go with this one, everybody. Good call out here, Zinc. Let's build the trade the way we normally would. I'm going to quickly launch my scratch pad just to remind you all of our general process, Remember, here we have full position sizes at $10,000. We try to risk no more than 1% of the portfolio value, 1% of 100,000 with which we began, so $1,000 of max risk. And our stop orders, 1 ATR below the preferred SMA, simple moving average. So we're going to start with the 10-day, and the reason is actually legitimate here, everyone, because if we do in fact break out, the potential exists for the 10-day to be our supporting moving average as we move to new short-term highs. Hopefully that's exactly how it goes. But again, the other reminder is the difference between those, the 10 and the 20, is significant. So you're looking at about $1.50 difference, which will eliminate, or I should say, reduce the amount of shares we can feasibly purchase. So let's, for proper and maybe a little more casual approach, because we haven't broken out and we think we might, instead of a full position size of 10,000, let's consider 5,000 for this trade. And so that would be just shy of 100, or a little more than 100 shares. That means we can work with 100 shares and do just fine. All right, so we're going to go with 100 as our purchase. We are going to go with a stop exit, $1.05 beneath the 10-day moving average. So I'm going to place that with a right click in the chart. And oops, not buy, but buy custom, excuse me. So we're going to do buy custom with a stop. And the close today was 48.59. We're going to give it a padded limit. We got to give it all the way up probably to 49. Remember, even though we're willing to pay up to 49, if we can, we will be buying it for less than 49. We always get the or better price. Now, thereafter, if executed at 49, we need a good till canceled stop. Let me make sure I've got the right number of shares in there. There we go. Yep. Okay. And we said we're going to go $1.05 beneath 47.23. So that's 46.18, 46.19. All right. And that is good till canceled for 100 shares. And so, again, because our risk is not to exceed $1,000, if we were to get stopped out at this with entrance at 4,900, right? Our exit to the downside at 46.19 means we're going to lose approximately about 300. But again, we can't guarantee that because that stop order comes as a market price. But it will at least put us in an opportunity to participate in an upside trade. And the reminder needs to be for us traders, it's okay to take a partial position, let the stock give you evidence that it's moving in your favor, and then add to that trade once that evidence has been applied, right? Yeah, you could also choose to protect oneself. Thank you, Wiley. We could explore alternate opportunities with option strategies as a protective measure. Some of you traders like to do that, even though that does reduce your opportunity for profit because it obviously increases your cost. But other traders like to let things happen and wait and see and then apply exit strategies after the fact. We're going to carry this one. My hope is that we get this one executed, added to our example portfolio, and finally putting in a position into utilities where we've got the exposure broadly in other spaces, healthcare, staples, industrials, materials, and energy. So this has been a pretty good approach for us. We'll see if this continues, but I think next week when we come back and reconvene, we will possibly be looking at an opportunity to consider technology or something else, because I don't mind adding to what's working here, but this is a big week with NVIDIA reporting tomorrow, and we covered it at the intro today. It's a possibility that NVIDIA's detail and commentary afterward could provide the necessary catalyst for the market to move higher. And if that were the case, and if we got technology to participate in what's been a good year in these other spaces so far, that could be really, really positive for the broad market. So we'll see how that plays out. All right, that's going to wrap it up for us, everyone. If you're coming to San Diego, make sure you come by and say hi. I will be there on Thursday. I'll be there Friday. I'm going to do a couple of separate branch visits, and then I'll be there all day Saturday, of course, for the actual event. We always have a wonderful time seeing you all, so please come by, say hi, shake my hand. Let's have a cocktail in the cocktail hour afterwards, whatever you'd like. Come by and visit. Make sure you're following Connie and me on X, Connie Hill CS, Kevin Horner CS, and hit that thumbs up button if this conversation was helpful for you today. And don't forget the survey opportunity, everybody. Always appreciate hearing from you. I hope you all have a fantastic rest of your afternoon, and I look forward to catching up with you again real soon.